Welcome to another episode of Real Estate Investing Explained. Here's today's question. I want to talk about how someone goes about deciding which deal to invest in on a platform like CrowdStreet, whether it is CrowdStreet or it's a different platform, any type of crowdfunding really when it comes to real estate. And I get asked this question a lot. So when someone's browsing through the various offerings, should they just always pick the one with the highest targeted IRR? Why or why not?
I'm glad you asked this question because I think this probably touches on a particular little bit of a hot spot in my personal perspective. So the answer is absolutely not. I think for listeners, if there's one takeaway from today's podcast, it should be that selecting commercial real estate investments solely on the basis of targeted IRR is a recipe for disaster. So now with that said, let's kind of peel that back. So to begin to understand why, I think it's valuable to start by thinking about the concept of the risk-reward spectrum. So imagine a graph, right? We've got an x-axis and a y-axis, and let's go ahead and plot returns along the x-axis and risk along the y-axis. So you go all the way down to no risk, start with a risk-free return, say that's about 2% today, and then we're going to trend, we're going to have an upward sloping curve. It could be 40 degrees, 38 degrees, whatever it is. It's going to trend upwards to the right, and it's going to continue on to add more risk for every level of return that you expect, right? And that's exactly what that curve is intended to convey. So for commercial real estate, well, we live within this paradigm. This is a curve that applies to us. And I'd say it's possible to shift this curve up or down, maybe, depending upon what you might know, what level of information. If you have imperfect information that you're leveraging to your advantage, now you're maybe getting a little bit better return for every level of risk. But at the end of the day, you cannot escape the idea that when you expect greater returns, you are accepting greater risk. It's just simply, that's how it works. So when we apply this graph to actually like real deals, and we think about them on a leveraged basis, well, I would say that when we think about the least risky deals, say the deals that are going to be what we call core and are going to show up in our marketplace. Well, targeted returns on those types of properties are going to range somewhere between 7 and 9% on an annualized basis. That's the basic. That's a core deal. You can feel pretty good. That's a deal you sleep at night. From there, we're going to start stepping out in terms of risk. Now, if we go all the way out to the end of the curve, way out there on the spectrum, we're going to have what we call the most riskiest opportunistic deals. Those can reach over 30% targeted on an annualized basis. But then what you are accepting is if you go for that deal, it has so many moving parts. It could be distressed. It could be vacant. It could be you got to tear down half of it and rebuild it. There's so much that takes on risk to get to that return that investors are accepting a very real possibility of principal loss. And I think the unfortunate thing is that when some investors are newer on the marketplace or just newer in general, they tend to view risk as a relatively constant, and they're thinking that higher returns on a targeted basis translate into higher actual returns. And that's where I just go back to, it just doesn't work that way. It could work that way, but it might not, and you might end up, with a deal that turns into a loss because, well, you're swinging for the fence. You swing for the fence every time, you got to expect to strike out. Well, when I think about assembling a portfolio of different commercial real estate investments, this is why I have always advocated for a blended approach when it comes to risk and returns. It's definitely fine for investors to go for the allure of that 20 plus IRR deal, particularly when the story of the deal is compelling and you're ready to take risk. But if you do, well, then possibly on the next deal, consider something a little less risky. Allocating to a deal, for example, that might be a stabilized multifamily asset. It's got conservative leverage on it. It's got cheap long-term fixed rate debt on it. That's a kind of deal that's going to target a returns in roughly maybe a 12 to 13% annualized range. But I can tell you that it has a much stronger probability of delivering those targeted returns than the deal that you just invested in at 22. It just, and again, I go back to this is the kind of deal that you can sleep at night. So think about risk and return as a spectrum and just know where you're plotting yourself and what you're expecting in exchange to get that level of return.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.